is to serve as a facilitator of information and to share among those of us in the business of space commerce. Our focus is primarily on the infrastructure, transportation, and supply chain elements. While it seems like everybody's lining up to go to the moon or go to Mars, like there's a bus outside waiting, there are a lot of steps between here and there. And from just business fundamentals, we're trying to figure out what the real nuts and bolts are to help us all get to where we want to go. This morning, we're going to talk about banking in space, and banking in the broadest sense of the term. It's something that that most people take for granted, but it is an essential component in any economic model. And it's I think it's fair to say that the commercial space industries just simply hasn't evolved to a point yet where traditional financial or capital investment, it hadn't evolved to where that's everyday practice yet. And that's, we're not going to solve anything about it today, but we are going to scratch the surface a little bit. Our primary speaker today is Nate Whigham, and he is you live in Puerto Rico, correct?
Yeah, I'm not from there originally, but I live there. That's right.
And I'm still waiting on my invitation to Puerto Rico to come down there and check it out.
Hey, man, it's always open.
Anyway, Nate's the founder and president of In Capital. In Capital is a commercial real estate investment entity. They've done about 800 million business over the last 15, 16 years. Nate has written a really good white paper that Tim Chrisman with the Foundation for the Future, they put it out as a white paper, and I'm going to share it with everyone here. Thanks, Tim, for allowing us to share it, and thanks, Nate, for writing it. Charles Stotler, who is his co-author on it, was going to be here today, but he said he was triple booked. So I know how that scheduling goes. So anyway, Nate, I'm going to go ahead and turn it over to you so you can start, because I know everybody's time is super valuable. We've allotted about 90 minutes. We're going to record it so we can share it later. But anyway, thank you. And Nate, I'll turn it over to you.
Sure. Yeah, absolutely. And I think we're waiting for a couple of our other people to hop in. Have Kevin and Eduardo come in yet, or no?
I have not seen them yet. I can ping them. I'll go ahead and ping them. Why don't you go ahead and start? So we got folks from every possible time zone.
Perfect. Yeah. All right. So yeah. So like John said, I'm Nate Whigham. My company's In Capital. We do general capital advisory, a lot in commercial real estate and some other industries, renewable energy and other things as well. But the reason I got involved in space is because I did the University of Mississippi Law School has a program, they call it a graduate certificate in space law. It's basically like half an LLM focused on space law. And I did that program remotely during COVID. I know Charles, who was my co-author on the paper, and that program led into a research project around the structure of the capital markets in the space industry. And then that, once we kind of understood what that looks like, we really recognized the lack of traditional debt and credit facilities for space companies and the need for that. And so the white paper we wrote is really talking about, how we can take these more kind of traditional credit structures and apply them to the space industry. And the space industry, I think, is in a really unique confluence of time in that there's a few very specific changing factors that really make the industry much more conducive to credit and banking than it's been in the past. And just touch on a few of them. One is the industry is becoming somewhat more fungible with standardized architecture. So if you think about space assets 10 or 15 years ago, everything's 100% bespoke. There's no way to repurpose it. It's usually a satellite with the size of a school bus. You can't really do anything with it other than its original mission. Today, that's changing, especially in the context of LEO constellations, because you're seeing, like you think about a remote sensing constellation. What is that? It's just a bunch of small satellites covered in every sensor you can think of that spin around the Earth about every hour and a half and collect as much data as you can. And then you crunch that data and sell it to different applications and industries. And so that is something that potentially has repurposing potential. So that factor coming on board. You have the fact that the industry as a whole is maturing from the ability to generate revenue at scale, along with some other things. So all these things are kind of coming together in a way that I think, like I said, really lends itself to the potential of kind of normal credit structures and other industries that we'll get into a little more detail down the line. So I see that Kevin came on. So I'm gonna hand it off to Kevin. He's going to go through a few slides and be prepared to really put the industry in context. And I think he's done a great job doing some research that I think will really help drive the point home of why we're going to really need credit if the industry is going to grow at the scale that everyone's expecting it to. So Kevin, with that, you want to take it away?
Yeah, thanks for having me. I'm sorry, I was changing a diaper, but I'm here now. I'll take and share my screen here if you're ready, John.
Yes.
And we can get this going. Right. All right. Should be everybody seeing the presentation? Everything good?
Yes.
All right. Excellent. All right. So shortage and need for financing in the space sector. Nathan has already introduced himself, it sounds like. I'm Kevin Barry, and me and Eduardo are co-founders of Lightbridge Strategic Consulting, and we've done several papers looking into the economics of financing and debt financing in the space sector. I believe Nathan probably already said this, but Charles can't be with us today, and Eduardo will be here in a little bit. All right. So just to sort of give context of why financing is so important and why we're really focusing on this is that right now, most of the US economy is credit. It's about a debt to equity ratio of about 85-6. So the vast majority of what we think of as money is actually a loan to a business or in personal credit or in various obligations that you have, like mortgage on a house. All of that money that exists in our economy is leveraged credit, which is still very useful and functional in the economy. And the reason that it is so prevalent is because financing, to borrow from the physics example here, financing, when it's functioning correctly and you're paying down your interest, functions like an acceleration on the velocity of money, which leads to an exponential gain in the amount of wealth in society. And this is a really good way to allow you to pay for things today you wouldn't otherwise be able to afford based on your expected increased prosperity in the future. It's the main way to really accelerate investing in any industry, any sector. And right now, what we're seeing in the space industry is that it just isn't very prevalent. In the last several years, we've seen a very rapid rise in the amount of funding coming from particularly venture capital, shown in teal on this graph. But this is only a very tiny slice of the overall financial market. Venture capital space is already at about 9 billion of the 50 billion of the entire US venture capital market. So there's not a lot of continued growth that can happen in the venture capital market. By comparison, the 200,000 billion or $200 trillion in accounts under management across the entire financial market is a much, much larger field to expand into. And it's going to be necessary as the space sector continues to grow. If we compare this to oil and gas, right now the space sector is about 370 billion, but the oil and gas industry is about 5 times that size at $2 trillion. But the difference is that in the last 5 years, we've seen a debt to equity ratio in new space of about 1:30. And actually in 2021, there was only one deal for $12 million, which for a $370 billion industry is just vanishingly small to the point of non-existent. By comparison, oil and gas, much more sort of a common sector, we're seeing a 1-to-1 or even more debt than equity in the sector. So they're leveraging $2+ trillion in order to prop up the oil and gas industry, which is really dramatically improving their perceived margins and the effectiveness of those companies to expand and continue operations. And since the space sector is projected to grow by 2040, depending on your source, to being the same size, if not larger than oil and gas, we really think that this transition to debt financing is going to be critical to that continued growth. And today we really want to look at two different ways we looked at going forward. Nathan is going to talk in a second here about credit revolvers in particular, to show how, despite the historical reliance on equity funding and government funding that space has had, there's new opportunities that allow us to use traditional financing models in space that are very relevant and have very good loan profiles by any industry standard. And then I'll be talking about what blended finance is and how it's such an effective tool in stimulating market participation, as it's done terrestrially in several energies, most notably renewable energy in the last decade or so here. So Nathan.
All right. Kevin, to keep it simple, you want to just control the slides on your end, so we're not sharing back and forth. Cool. All right. So I think that's great. Kevin was able to, kind of put all that in context. And the paper that that Charles and I wrote, that I think John may have just put in the chat, gives a variety of different specific examples, and we're not going to go through all of them. But the one that you're looking at here is one that I think is probably the one we're most excited about, and I think is really interesting, which is the concept of a revolving credit facility for LEO constellation operators. And the reason we thought about this is because you think about a LEO constellation. Obviously, it's a group of satellites in low Earth orbit, typically very small sats. A lot of times they don't even have propulsion because they're quite fungible and relatively disposable in the sense that they have a very short useful life. Typically, a LEO sat's life is in that kind of constellation is going to be, call it 3 years to 5 years, something like that. Because in LEO you have higher gravitational pull back to the Earth, you have higher atmospheric drag, and so the satellites, after 3 years or so, typically just burn up, and it's not a bad thing in the sense because you have to continually relaunch satellites to maintain a constellation. You're also always able to consistently and frequently upgrade your technology. So it's basically how LEO operation works. And when we did Charles and I did the research project that led to this paper, we had the opportunity to talk to a whole bunch of different industry participants. For example, we spoke to the CFO of Iridium, and I could rattle off a bunch of names, but what they told us, when we spoke to all the LEO operators that we spoke to, basically as they're describing their business model, and me being a finance guy, I look at this and say, okay, you have an asset in service that is producing current cash flows that requires a highly predictable annual capex to maintain the asset, i.e. in the annual relaunching of these satellites to maintain your constellation. In any other industry, that type of scenario easily financed with a credit facility. And when we were having these conversations with these operators, we're saying, well, how are you financing it? And this is before everyone did their SPAC. And so their response was, well, we're just issuing new stock, which really blew my mind. If you think about an operating business that's producing revenue, that has highly predictable ongoing capital expenditures to maintain a specific asset, and to fund that capex, you have to dilute your shareholders, which is just completely, to me, that was nuts. And it's very capital inefficient. It's very expensive. There's a lot. Rattle off a whole bunch of reasons why that doesn't make a lot of sense. And so we said, wow, well, that is the perfect type of application for this revolving type of credit structure. So we looked at a couple examples. One was Starlink. The one you're seeing here is Spire. Most of the assumptions here were taken out of Spire's spec deck, because when we spoke with them and put this together, it was kind of maybe a month or two before they SPAC'd. And we just said, okay, let's make some reasonable assumptions about satellite costs, launch cost, how many launches they need to do per year to maintain the asset, and what that income looks like, and see what those credit metrics are going to look like. And I'm not going to go too deep into the finance weeds here, but the real takeaway from this is that if we were a lender, if we gave them this type of credit facility that we're contemplating, and based on these metrics from a finance or credit underwriting perspective, these metrics are very good. You have over a 4x debt service coverage ratio, which means that the company potentially is going to produce about 4 times in EBITDA of what their annual debt service is going to be. And typically in corporate, looking for a 2.0 or even sometimes down to a 1.5, depending on what industry you're in. If you're in commercial real estate, that can go down to like 1.2, depending on the asset. So again, from a credit underwriting perspective, that's a really compelling loan that you're able to make. So this was just one of the examples from the paper we looked at. Said, okay, let's just put our lender hat on, look at a space company, just crunch the numbers and say, is this a good loan or a bad loan? And what we came to the conclusion on this one and many others is that, wow, these look like pretty good loans, pretty compelling loans. So that really leads us into, that's part of what we were talking earlier, where the time seems right in the industry for debt to be moving into in a big way, not only because of the need for debt to scale the industry, but also because the potential credit metrics and loan structures you can achieve based on the analysis we've done seem very compelling. Kevin, you want to go to the next one? So like I said, we thought about a whole bunch of different use cases. The one that you just saw and the other ones in the paper are loans that we think you could actually potentially make today. But if you think about what the future of the credit markets in space look like, I really think about it from the perspective of again, the commercial real estate world, where you have a very diverse and robust credit market with a wide variety of credit structures, depending on the application and the associated risk profile around that. So think about construction loans to build buildings, bridge loans to bridge asset, I'm buying asset, I'm rehabbing it. Just regular term loans. I bought something that's stabilized, I'm going to put a bank loan on it or mortgage on it. I want to use a loan to buy land. I want to get a loan to build infrastructure. There's this, in most other industries, there's a very wide and robust range of credit products for your operators to access depending on what they're doing. And I think in the very near future, space will be no different. So you're going to have credit you can access that'll be in different structures depending on what you're doing. And some of the examples we put in here are, you might be able to use a loan to finance an orbital debris bond. It's another, kind of, I think, really simple and easily achievable use case. We're seeing the rise of orbital servicing fleets coming online. So I think in the very near future, you're going to have fleet financing for those fleets like you would, a rental car company or a tow truck operator or anyone who has fleets at scale. You're going to finance that. Orbital fuel depots are coming online. Same thing. I mean, think about futures contracts for space commodities like fuel and other things, financing of in-space manufacturing facility. And then kind of the ultimate one is going to be the construction of actual space habitats, whether those are commercial space stations in orbit or their facilities on the moon or maybe even other celestial bodies. But as those credit markets mature, I think it's very feasible to presume that sometime in the near future, if I want to build something on the moon where there's a very clear and understandable economic case for that to construct that asset, I'll be able to get some level of debt against that construction cost.
And we have a fair amount of historical analysis that we've looked into on this. And there's a lot of comparisons that can be drawn between the development of naval financing. P&I clubs, or I think it's protection and indemnity clubs, are sort of the foundation of modern insurance. And those were literally based around salvage operations and the likelihood of ships going down in storms. So there's a very high correlation to what we're seeing with orbital debris, and the same sort of idea of paying port fees in a marina, paying service fees to a Coast Guard. Like, these kinds of services have a lot of very similar parallels to what we see in the naval industry and in colonization and expansion, not just into quote, the new world, but into new sectors and new regions. These services typically build up in a very similar fashion. And right now, space is lagging a little bit behind. And part of the reasons that I want to talk about blended finance is that blended finance, more than anything, is a catalyst for trying to overcome some of these high barriers to entry. That space has very high early capital requirements. It's very difficult to get something from an idea to a product in space just because you have to do quite a bit of physical development, launch it. There's many different pieces, and the timeline on when you can get from idea to generating revenue is quite long compared to many industries, much like it is in commercial real estate. It's just not a particularly fast industry because there's quite a bit of development timeline that has to be considered. And blended financing is something that is used typically in international economic development projects. And what it is at its core is a government or some large philanthropic organization like the Gates Foundation provides concessional capital, which is to say they provide a large amount of capital on the conditions that X happens, but they're not asking for a return on it. They are giving it based on the project meeting certain metrics and getting this funding. And they use this in order to incentivize and motivate private market participation. It's a term which annoyingly is also called leverage. And they typically are receiving in terrestrial projects anywhere between 5 and 9 times their original investment. So when considering a large space project, governments are having limited funding that they can allocate to any project. NASA is chronically short of enough funding. Investors see a really high capital cost in front of them, and they just can't afford that kind of equity draw. And banks are too risk averse to give a loan on something so audacious. And with blended financing, governments who have the ability to have the resources to look into a project to see if it is viable and if it's a product that the government would want to take part in. NASA's line of it wants to be one customer among many. If it identifies itself as a customer via blended financing, this will maximize its impact because it's going to get a much bigger growth in that area than they would if they funded the project internally. For investors, because the government basically raises the floor so that instead of walking away from a project with $0, if it goes belly up, you're at least getting the government's payout. This really improves the risk-adjusted returns fairly significantly. And from the bank's perspective, you're minimizing risk because now you have an even greater cushion with which to finance the investment. And the economics of blended financing have shown to be very promising. In the last decade, it's really risen in prominence. The World Bank just funded $156 billion towards blended financing project to achieve many of the sustainable development goals. And much of the use of those blended financing funds is to develop new industry, particularly renewable energy, which are fitting in with the sustainable development goals. And space has both the high perceived risk, which makes it ideal for blended financing, and it has a high correlation with achieving a lot of different sustainable development goals. Not only is space very strong in environmental monitoring, it's also very low carbon intensity compared to most other industries, compared to the amount of GDP that it can deliver, the number of jobs it can create. And it's performing very well in lots of the metrics used in blended financing today. And so,
Kevin, a quick insert. Can you, your lower right circle, the investor?
yeah,
Putting those Venn diagram elements in the same size is a little misleading in my opinion, at least, but I'd like you to comment on, are investors getting this message? Is simply what my question is. And any answer will do, but I wonder if it's a learned answer, if we really know what the investor is thinking. Thank you.
well, I mean, first of all, this is not meant to be a at scale Venn diagram. It's just, they're all equal. But I would say that the investor returns that we're seeing from blended financing projects in India and China and Africa are doing exceptionally well. Infrastructure projects are in general very defensible. The rate of failure on infrastructure projects is about 3% in Africa, and the rate of return is about 18 to 24% year over year. So those are very good investment metrics by any standard. You know, it's not that rate of failure, your risk in investment. Most of the problem is this high perceived risk that if you're trying to build a highway in the middle of the Congo, people aren't comfortable with that idea. But if you have it backed by a government agency or a large philanthropic group that can kind of be a guiding hand to make sure the project works out well, that significantly decreases the perceived risk of the project. And as a result, the actual fundamentals of the company don't necessarily change very much, but the perceived risk does. And so investors do end up getting quite a strong return. There's a reason that the ascendancy in blended financing has been on pace with the ascendancy in venture capital into space. We've actually seen a greater nominal rise in blended financing than we've seen in venture capital funding to space, just to compare volume of transactions. And right now, there's not a lot of overlap because blended financing is still within the international economic development field. But in many ways, development of space, you can think of it almost as if it is, quote, another country that is needed development, has the same infrastructure needs as anywhere else to develop a stable commercial economy. So just in summary of these ideas, we've really seen that capital to date has been mostly coming from venture capital and government equity, and that this is a very inefficient form of capital sourcing. And the space industry is continuing to grow very rapidly as we're getting more and more opportunities. The cost of getting to space has been plummeting. We've seen almost a 4 order of magnitude decrease in the last 17 years of the cost of getting anything into space. And so the number of market opportunities is going exponentially up right now. And all this growth is leading to some of the companies that are starting to become quite mature and standardized and have long-term revenue lines that aren't just brochures and pie in the sky ventures, but real cash generating entities. And as more and more companies start to stabilize what they're able to do in space, whether it's mostly in telecom right now, or in GPS services, development of broadband internet, this gives opportunity for conventional capital and conventional financing sources to play a bigger role in funding space rather than diluting shares or seeking more equity directly. And blended financing, we argue, is a very good catalyst to help this transition happen even more smoothly. That right now, the loan fundamentals, as Nathan pointed out, are exceptional. You know, there's really no reason not to go into it other than a lack of understanding and a lack of understanding of the real risk compared to the perceived risks of this industry. And blended financing can tip it over the edge to make it a much more viable investment for the financial community. And Nathan and I and Eduardo and Charles are working to say we want to build up that private credit vehicle to really focus on space based funding and to use some of this knowledge and bring over more of the financial community to participate in a direct vehicle. And we have plenty more research that we've developed. And here are a few links here. I believe this PowerPoint will be disseminated at some point, but you can visit either Lightbridge or In Capital to find out more about these projects. And please ask us questions.
Yeah, let's open it up now to general discussion. I mean, we obviously have our point of view, but we're really curious to hear what everyone else on the call thinks about this concept, the need for credit in the space industry, et cetera.
All right, please feel free to ask, but my number one question is, okay, What's the
this-
next step?
John, this is Fitzer. I have one more aspect of this that, in my, hopefully all know who I am and what I'm trying to do. And I'm on a 15-year to 25-year timeline for when I talk to investors. And boy, that just shocks them. It just drives them crazy. If they're at all founded in the current capital investment arena, 15 years is just untenable. As a consequence, I'm looking at other sources, not just a classic investor source. But Kevin and Nathan, can you speak to when can we get the financial industry? Let me make that an accusation, okay? To understand that the time constants for space activities is longer than it is for GameStop, for example, which is 18 months, not 18 years. Just the time constant, Kevin, just like, you know what I mean?
Well, I would say the financial industry and the public markets are not going to be comparable in their time constant. I think that one of our observations, and this is the paper that we're working on for presenting later this fall at IAC, is when you have new industries, if you think of JP Morgan Chase, giant bank today, when the Transcontinental Railroad was being constructed, JP Morgan, the individual, was providing a lot of the lending and providing a lot of the funding to the early railroads and eventually to the Transcontinental Railroad itself. But it was him, and it was a small institution, and the major success of that investing is what made JP Morgan the monolith of banking today. That banks traditionally don't invest in new industries, and they don't take and support the new guy. They're very conservative in the way that they approach and the way that they fund operations. Banks want to look at something that has 10 years of proven revenue before they want to talk to it. And the opportunity for the financial industry is not as much the big players as it's the new players coming onto the field. And there will be a role for big banks, but I expect that they're going to have a relatively minor role, just as they have in every previous transition that we've seen, whether it was electrification, building of canals, building of new highway systems. Like, banks are something that is the late stage of development. And right now we're still in the growth stage. So we need to look carefully at what financial vehicles make sense. And this is more of, how does a small bank take and start funding this? And that bank won't necessarily stay small, but it has to have that hunger and that agility to be able to adapt to a new industry paradigm. And that this is different than public markets, which are focused a little bit more quarter to quarter. And if you're looking at a quarterly return, 15, 20 years out is not very interesting. That's, to have that kind of foresight in the public markets is very rare in a portfolio. And that's a bigger macro question that I don't have an answer for you, Fitzer. But does that help explain kind of the difference of what we're seeing in bank? Would you agree, Nathan?
Yeah, I mean, I would add a few things to that, which is I would agree with everything you said in the context of developing kind of long-term infrastructure for space. Part of what we had talked about, or, when I went back, I was talking about what the future space credit market is probably going to look like. So it's probably going to mirror most other industries like commercial real estate, infrastructure, energy, et cetera, where you have this wide and diverse range of credit products that you can access, some from banks, some from private lenders, various other sources, depending on what you're doing. Today, there's really not for space from a credit perspective, or I would say what's available is extraordinarily limited. Part of our thesis is, if we're going to put together a credit vehicle for space today, probably going to start with what are going to be the easier loans to get done from a risk perspective. And that's the examples that we gave, the revolving credit for a currently operating LEO constellation. And the paper, we talk about some others, like maybe a single asset-based loan that's secured by a flexible use geosat, maybe even just lending against a combination of existing space assets and ground-based infrastructure. These are all things that are producing, income today that we can underwrite and we can leverage against. And so that's where I think that that's the simplest place to create credit for the space industry, because that's going to be the easiest place for credit investors to get their heads around. But as you demonstrated that concept, that credit market is going to grow and mature, and you're going to most likely, which is basically what happens in every industry, you're going to see new investors come in and be willing to take a little bit more risk against different types of projects and applications in exchange for a slightly meatier return. And over time, that grows into your large and comprehensive and diverse, credit market, where you can kind of finance anything for the most part. And so I think from a debt perspective, it's less of a question of kind of the timeline that you're looking at, and more, what can I underwrite today from a credit perspective that's going to get an investor interested.
Absolutely. And I think that approaching the low-hanging fruit is the way to go. Especially in financing, more precedent is really what we need. Anything that is a, knock it out of the park investment opportunity is what you have to start with. And you get closer and closer to what is market competitive as you get more precedent and confidence in doing it. So something like commercial real estate in the US is one of our most stable markets, and that's going to be sort of the gold standard for what you can get away with in terms of loan to value, or how much of an extension of faith you're getting because of the transferability of the product and understanding from banks of what is possible. And right now, that institutional know-how of how well an asset will or won't perform, because the space industry is still so much in flux, you really have to have something extraordinarily competitive to make a dent. And that's what we're starting to see, is that these opportunities 5 years ago weren't very existent, but that's changing. As you're getting more stable revenue lines, it's not a gamble anymore. And that's what we want to start investing in.
It's the stabilized revenue and income, and it's also, again, kind of the fungibility of the assets themselves. Because if I'm a lender, the big fundamental difference between equity investors, VCs, et cetera, and credit investors is, the equity guys are on the upside. Investment because they're hoping it goes to the moon and you make a lot of money over time. Credit guys, we just care about making good loans. We want to make a good loan where we get paid back on time with interest. That's it. And so when we think about, from that perspective, we're underwriting those current cash flows from that debt coverage perspective. And then the next question we have to think about is, if a borrower does default for whatever reason, what can I do with this thing? If I have to take possession of it, or take control of telemetry, or put it in receivership, or whatever it is, now what do I do with it? I'm a lender. I don't want to be a satellite constellation operator. So it's really important that there is some secondary market or secondary value. I can take that asset that like borrower A defaulted on for whatever reason, and I've got someone else that is willing to buy it or operate it for a fee, or there's something I can do with it. And that's, I was saying earlier, the industry is moving more towards that standardized architecture, somewhat more fungible assets, and that you really need that for credit to make sense. Because again, it gives, as a lender, gives me some optionality in the event of a default.
Right. And going just in tandem with that idea is the legal precedent, not just the technical capability, but the legal ability to recapture an asset, and having a contract that you can uphold in court that this person defaulted, I'm recapturing these assets. And those are on paper, and we need to build up more of a legal precedent and a legal comfort with those sorts of contracts and that process taking place in the wider marketplace, so that it is a understood recapture point. And that goes as well for liens. Even if you're not having a full recapture, can you take and put pressure on your operator to garnish their income or due to various things, those steps to recapture, as Nathan said, is what separates equity from credit. Equity, they have to ride with whatever happens. Credit has more tools at its disposal to be like, no, I get a clawback of you didn't give me what you said you would. And getting those teeth in place to make sure that that works out as expected is part of the reason that there's so much perceived risk, is that you don't know what's going to happen. Even if it's on paper, it says it should, what's on paper and what actually happens doesn't always mesh up.
Hang on, David, you had a question?
I did. We're about 5 months away from the 60th anniversary of Kennedy giving his famous moon speech, and nobody's talking about it yet. But as we get closer to that date, I'm sure there'll be talks of it. But there was a catalyst for this endeavor when Kennedy, essentially said, we're not interested in matching the Russians. We're going to beat them to the moon. What do you're in the space much more than I am. What catalyst do you see right now that will have that type of effort where we're going to see this channeling of resources into, pardon the pun, the next frontier?
I mean, I would say the easy answer to that is what SpaceX is doing with Starship. I mean, it is difficult to overstate just how impactful the cost reduction has been. I looked really closely at aviation as a similar parallel, where in aviation after World War II, you had a few flying aces who had been pilots in the Army, and the cost of going to Los Angeles to New York in the 1940s was about 10 times what it is to have that same flight today. That's one order of magnitude in price difference. And over 35 years, the sector, as you had commercial turbines brought online as a technology to when that was distributed, you saw an exponential increase in the amount of users and the amount of freight shipped with airline cargo that went in lockstep with the cost reduction in the technology. And that's based on one order of magnitude reduction in price. And what we've seen in the last 17 years since the space shuttle launched is $54,000 per kilogram to get anything into space. Starship is notionally going to be about $100 per kilogram. So that reduction in price is driving the sort of space renaissance. What is the drive to do things in space? The fact that I can now get 540 times as much as I could before. And so does your satellite make sense? How does 540 of that satellite make sense? That's really, I think, what's driving the difference.
That's a great point. But, if I understand what you're saying, there was a reason to go there. In the case of going transatlantic or across the country, there was a reason. There's something there. That's and I don't know if it's when the John has mentioned this before, when the Corps engineer can figure out how to put a building on the moon, if that's when it's real now. That now they, as opposed to just going up there just to as a space tourist. Any thoughts on that?
I think there's kind of two answers to your question, David. One is, and I think what Kevin described with regards to Starship is right on the money and will be so much more meaningful and impactful than most people really understand, or I think are prepared to think about. But the real answer, but that's really a discussion about infrastructure, right? Cost. I think there's two things. One is economic opportunity is going to drive all this activity, which is certainly related to the cost to put stuff there. And economic opportunity in space is frankly unlimited, but the things we think about today are, going to be resource mining in space, nuclear power, nuclear fusion on the moon using helium-3 is probably going to be very, very meaningful. All of your remote sensing that we're seeing now, all the things, broadband internet that's coming online, and
Space, solar power.
Are
There's a huge, I think that the important thing for finance, and this is something we really delve into in our paper, is that we can wax on about the potential values of space. In a similar vein, I could take and say, look at the Rocky Mountains. The Rocky Mountains are filled with so much gold. If I could just snap my fingers and have all the gold in the Rocky Mountains, oh, what a wealthy person I would be. But it doesn't matter at the end of the day how valuable something potentially is. What matters is how much does it cost for me to put a mine, and then how much does it cost for me to get what I mined back to somewhere I can sell it? And how much value can I create, can I extract from that environment is what is meaningful. And what you can extract and bring back is fundamentally linked to the logistics cost. And when we see the logistics cost falling that quickly, the business case for what does or doesn't make sense is really changing. And that's what I think Nathan is really getting at, is that the potential value of space has never been in question. Can you meaningfully extract from space is what has changed. If I can take and say, this asteroid has $150 billion of platinum metal group metals, and I can send an operation there for $10 billion, and I can extract all 150 billion, I 15x'd my investment. That is a plan to extract the value. And what would have cost $100 billion before might now only cost $100 million today, because you've seen such a dramatic drop in cost. And so it's that delta, and how the balance between what I would like to do and what I can do has changed.
Yeah, and the other thing I would add to that is that's all the commercial economic side of the equation. The other side is geopolitical. If the US, I think, has a really clear security interest in being the leader in development of space on a variety of fronts, and promoting commercial and economic development for US entities. Because if you think about it, you control space, you basically control the planet. And, I think we'd all prefer that, we control that, or at least heavily influence it versus other actors.
And, of note, launch infrastructure is compelling. And I think that right now it's very much in its ascendancy on this sort of the S curve of growth. It's in the exponential increase, but it's also over reporting. It's too hot right now. There are 257 launch companies right now, and it's not going to be stable. So our expectation here is that, just like we experienced in the .com bubble in 2000, there's going to be too many high flyers. The market's a little bit too, brochures and PowerPoints of what they can possibly get. And there's going to be a correction. And the after correction, the companies that make it through, Google, Amazon, they were large companies that went through the .com crash, and they didn't go bankrupt. And sort of over time, they just kept accruing more and more market share, and increased the size of the total addressable market to the point that they're some of the largest companies on earth. But it's, that's what we're going to see. We're going to see a shakeout, and that the ones that survive, they're the ones that are really going to drive financial transactions, because they have that pedigree of how long they've been doing it. And that's where finance really hits its stride, and it takes it from the upward slope of the S curve to the flattening part of the S curve, where you start focusing in on margins, and you start leveraging your debt in order to maximize your returns, but you stifle growth when you do that. You get to a point you can't keep growing so quickly. So Bruce, you've had a question for a bit here.
Yeah, no, Nathan and Kevin, thank you for this presentation. John, thank you. You all may have seen some of my papers starting in 2016, including at IAC, talking about space finance and the need for a diversity of that. So I'm all aboard that.
All right.
Investors and lenders, in terms of how much of any of these assets we need in comparison to the services they deliver in comparison to the other assets that need to be financed. So that, it's important, I think, to keep in context that we can, when we make the analogy to project finance as opposed to geo finance and general obligations forms of finance for a city, that there's an implicit understanding of what that demand curve looks like, where, and in regard to what else. So, it's great work. I look forward to seeing the papers, and it'd be great to talk and see how our research can align.
Yeah, and as I said, Nathan and Charles and Eduardo and I are working on a couple of papers this fall to really dig into one of the things we want to investigate, which is not as easily accessible, is the how much the space sector is actually taking and having debt. A lot of the figures that I given today are talking about new space, which is kind of the most relevant, but there's still a lot of old space. And when you look at something like, your Northrop Grumman, your Boeings of the world, Northrop Grumman has a $2 billion a year line of credit. And the way that their line of credit is used for drawing down on debt and cycling is not publicly available data to say how and where they're spending it, even though 1/5 of Northrop Grumman's revenue is their space sector division. So we're trying to dig in a little bit more to understand to what degree are internal financing arrangements for debt obligations taking place based on larger companies that have space as a subset of their portfolio. Similar to what we saw in the rise of the internet, you don't necessarily have internet companies as the only thing. Every company has an internet presence now. And similarly, we think that over time, you're going to see a transition to every company is going to have a space presence to some extent. I mean, John Deere is a very large actor in space because of how important GPS tracking is for all of the different farming equipment. So what you would think of as a classically not even close to space related, there are several companies that have a fairly large space presence already. And their internal financing against their terrestrial operations is something we want to see just how deep that goes, to your point of sometimes it's about your existent commodities more than it is just what's up and coming.
Yeah, and Kevin, if I could point out, I see the finance, what you've called blended finance, as a Rubik's Cube that you have to turn to tell a certain kind of story to a certain type of investor with a certain time and risk, preference. And you're not eligible to tell that story as a space company for some time. So there are elements to that story that need to be dug into, and how the government as a prime customer can help with those storytelling elements, I think and consistently be relied on to tell those story elements is pretty important. So we can talk about all of that.
All right. I have gotten feedback from so many people that have said this is a phenomenal discussion. Bruce, thanks for being here. I got a couple of questions. One, the most obvious is, what's the next step? You guys, I've loved this because it's been so logical, and it's not, stars in your eyes. It's okay. What are the nuts and bolts from a fundamental business perspective to get us where we need to go? This organization and Tim's organization, Foundation with Future, we try to work very collaboratively. So let us collectively leverage this information that you're bringing to the table. I invite y'all to tell us how we can help get the word out and identify specific actionable items, whatever they are. We've talked about so many things today. How can we pick a few to start telling that story? Is that where we Is that
I'll
what
tell you
can be most valuable?
exactly what it should be. Yeah, so where we are right now is, you've seen the initial analysis that we've done, which is based on, the data that we could find for a few specific companies and what we think are some reasonable assumptions. The next step that I think we need to do is we want to talk directly to currently operating space companies that would have an interest in accessing these types of credit vehicles and actually do some direct and specific underwriting around their business. So, and that could, we could rattle off a whole bunch of names, but all the Leo constellation operator, I think very interesting, and any other company that has assets in space that are producing revenues today. We'd like to talk to them. We'd sign an NDA, collect some information from them, and we actually produce some credit memos specific to those opportunities.
I would love to be involved in that. If nothing else, just helping to, Alia, I want you to talk about it, but please let us help serve as a venue for that, because that would be huge. You've got something that's extremely relevant to this.
Yes, I have, I'm here from Brazil. In Brazil, we have all the commodities. So we have the big companies here to invest on all this. I am expanding to United States because, yes, I will find better the investments of all this. I could see some different scenarios in Europe about how the big banks goes to the little companies, the starting companies. So I saw some good examples. How can the bank do this of the small companies? Because they do as like incubators. They own the incubators like this. So it's a kind of guarantee that you can make it into an incubator to do all the things about you need to get growing, to them to believe that they can believe on you and put their money on you. So I saw this different way, but I see that in the United States, I have more capital, more investment for private capital for this, because there in Europe, you see more government doing this, but I see a lot of subsidies into this. So sometimes I see very good things about examples that what they are doing. I really agree with Bruce, because I went to Luxembourg to talk to many investors, and I could see some ones I need to talk about sustainable way of life, of things that I will impact on. And sometimes I can't say nothing about this because they just don't like it. They only like the numbers, and I could really experiment all this. So I, like John was saying, I'm really interested on be into a succeed case, going to United States, have a very big market as I have here in Brazil and all over Europe, because I've been all over to have a lot of big markets of the commodities of agriculture, for oil and gas, because our mission of nanosatellites is for the Earth observation. So we have a lot of market for this here in Brazil and all over the world. So I have a very good market. I have a very good company, but I can't stand here in Brazil because, as Richard said, I think Fitzgerald said, Michael, he said, when he went to an investor 50 years ago, for me, it's the same like now here in Brazil. I go to any investors here in Brazil, it's like we are in the past, like 80 years ago, so here we don't have any matter. I can agree a lot of Kevin saying about a comfortable way of precedents or things that we can have for the law to give my environmental more comfortable to leverage my companies. Here in Brazil, I'm discussing a lot about law. I'm doing a lot of groups that we are discussing this all the time to have the law more support for us on these situations of financial, because we don't have our governor to be the trust of every other investor that would like to fund us. So I'm facing all this you are telling there, and I'm really prepared to do this in the United States, to go with my company there and start this mission, and to be the one that have experiment all this, and then I can tell the good way and the key that they can deliver all this, a little company that to go grow, nothing about to have a very big company or a big like a pass with a lot of very big submissions. We are in the starting of everything. We have a very good impact on all the things. Me as a female leader is some very good impact that I see that United States are really concerned about, and that we have a lot of reason to be funded, to have investors interested on us, and that's why I have all this market here, but I'm going to United States on May to begin all this movement. And I mean, if you all mean, in this situation of having a succeed mission with many hands, putting this as a very good case to go as a use case. So yes, this is me. This is Alia nowadays.
Yeah, and if anybody wants to talk to me more about it, I'm here just north of DC, and I'm going to be presenting again in ISDC, and I am not the expert to talk about it, but I definitely have been in many conversations, both with StellarModal and elsewhere, in talking about the legal side on how we get that a little bit more forward. And there's some interesting movement, in what we can utilize in having blockchain as a means of securing that ledger. It's been a big part in the United States for real estate, how important the bundle of rights and the way that that is structured. It's one of the reasons the United States has such a strong real estate market, is the very clear property rights delineation. And right now, the status in space is less clear. I would say that there's an uncomfortable amount of gray area. And insofar as there's a solution to that problem, I think that one of the, quests of StellarModal, for lack of a better word, is to bring more clarity, especially with regards to legal ownership and to transfer of possession, to what and what you can't claim, and to what are the teeth if somebody breaks the rules. And that is something that I think that a trade organization would have as sort of our chief thing that we're focusing on, is how do you make this a good marketplace for all businesses to play in? I mean, that's really, I think, the takeaway I've gotten from all these different eras that I've studied in terms of economics. What really separates the early phases of development of an industry with when that industry becomes a mature industry is how well the institutions around transfer and how well the institutions for commoditization, and as Bruce has been saying, and like the more stabilized the institutions are for an industry, the better it performs as an economic marketplace and less as a speculative marketplace. That's what we need, is we need to build up those institutions, because right now they kind of exist, but they're not strong enough.
Lucky you, because in Brazil we don't have, it's non-existent. There is no way the institution here to cooperate or collaborate with us. And all the time when I go to international investors, they always say to me, you have unstable political and you have unstable economy. Sorry, we can do nothing for you in Brazil, because we faced all this kind of problem, and we don't have the governor at our side. We have the governor like against us. The behavior is like a competitor from us. He couldn't really realize that the space for commercial can really solve a lot of big problems that we have and we face here in Brazil. So this is another thing that we need to do all the time, is talking with the institutions, having a very good environmental ecosystem growing up to show more how we can solve these problems, not we as a competitor, So one more time, yes, we face a lot of difficulty here. I think it's very good to say all this to you, because you can see that you have a better environmental to make it happen on your country.
All right. Well, you've definitely got my squirrels running here. We've got a lot to talk about, my friends.
John, we have to expand the audience here a little bit somehow. I don't mean that as I'm picking on you, but rather to praise you and Kevin and Nathan and Alia, for that matter. God love you. And when somebody says to me that, we can do this miracle in space 16 years from now, and they say, "See you later, alligator," it just hurts my heart. It just hurts my heart. And I've been in this business for 52 years, believe it or not. And they were wrong 52 years ago, and they're still wrong. What you get my irony in that statement, Kevin. I hope you appreciate that.
We're getting there, Fitzer. We're getting
all right. By the way, on the side, let me talk to you tomorrow. I got an idea that you and Kevin I need to share, but I have to check it with somebody before I can say it out loud, please, and thank you.
All right. Just like we said earlier, next month we're going to start talking about supply chain. In the very near future, I'm going to wrangle Adrian into talking about advanced materials. We've got to, on these things, you're right, we need to get bigger, but right now we're just scratching the surface and we're just figuring out the questions to ask. We got to get Charles back in to help lead a discussion on the legal aspects. Any additional topics that you can think about, let me know and we'll start putting those together. Christine, thank you for helping to lead the discussion on blockchain. Again, we just scratched the surface. We need to go back and revisit. Bruce, again, thanks for being here. What have we left unsaid? What do we need to do?
I mean, I think
John's Covenant here. Sorry, Kevin, I'll be very quick. I'll be very, very quick. Don't forget the question, what's left to do? I'm a lawyer, UK-based lawyer. I'm not a space lawyer, but I've got a great interest in space law. I'm a general commercial lawyer, but I really have a huge interest in space and in new space. So I missed a bit of the session. So I didn't hear what you may have said about the obstacles to debt really taking a huge role in the sector. We can discuss that some other time. I wanted to know what the obstacles are. But from my point of view, I think the legal, because I think Ali was talking about the strength of the institutions in the US as opposed to in Brazil. And it's one thing having the institutions, but do the institutions know what they're dealing with? Do they know how to deal with it? I mean, the institutions can be there, but they don't have the tools or the understanding. They will still struggle to deliver an effective regime. And my interest is in how the legal regime, how the lawyers fail or support the initiative of creating a workable new ecosystem for the space sector. And I think we're failing at the moment. I'm not a space lawyer. It's something that I want to do, but I'm very interested in supporting what you're doing. I think it's fascinating. And I have a couple of ideas. I think blockchain and DAOs have a real role here. So very much want to stay involved and contribute to the legal aspects of what you're doing. And it's been a great session today. So thank you very much to everybody who's contributed to it. Really very important session. Thank you.
Well, Ms. Hughes,
you keep leading that charge.
So,
okay.
so Kabina, out of professional courtesy, I have to say I am also a lawyer in California, New York, and Pennsylvania. So I'm a bond lawyer and a commercial transaction, government transactions lawyer. And that's what's led me to focus on the space commodities exchange. It exchanges create certainty for what is traded and the terms on which it is traded and the default remedies when it isn't. Those are topics that we can explore.
Bruce, there's so much I could learn from you. I've just met you today and heard you, and you're someone I'm going to reach out to. I really want to learn a lot from you, and thanks a lot. So yeah, I look forward to our relationship developing.
Cobina, here in Brazil, we have a very strong space law group of space law here in Brazil, just to discuss a lot of things about the aspects of the space sector, but the other things about the ecosystem that needs to have more strong law our support, because we don't have many support here. I went to a class, I teach a class of space law here in Brazil. I have on my team a space lawyer that he is doctor on space law, and he's facing a lot of different challenges with me because I'm going global. I have a lot of global partnership, and there are many things that you need to discuss about space law in these fields. So anytime, let's go to discuss some things about this, because I have a lot of things to tell you.
No, absolutely. And I'll be very brief again. I think the problem that I have with space lawyers is that they tend to be very narrow tracked. Their training and everything sets on certain tracks. So people talk about the Outer Space Treaty and other obligations, militarization and so on, but they do not think about the kind of stuff that we're talking about. And that's why Bruce is so important to me. Thank you.
Well, one other thing I'd like to throw out there is that we have a delegation in from Hong Kong for this meeting too. So one of the things that we try to focus on is collaboration, and there's cultural collaboration. And we're talking about, you know, there are key issues in Brazil, in Hong Kong, in Europe, in the US. There are some things that we do have in common and that can be the low-hanging fruit. And that's one thing that I would really like to see if we couldn't focus on and have actionable deliverables in a short term. I don't know what they are yet, but instead of just having a discussion forum, I'd like for us to try to get together and figure out, okay, let's just pick a topic and drill down into it. That's what I'm going to be pestering you guys about in the very near future. So,
Yeah.
guys,
I would say on that note, John, one thing to have on the eventual agenda is looking more closely at specifically launch and the logistics of that. You know, when we hear Elon talking about having 1,000 starships launching potentially 3 times a day, which has yet to be seen, but that is the byline. Where are they launching from? I mean, if we're going to have point-to-point transfer from locations on Earth, or if we're going to have multiple relaunches in orbit, some way, somehow, there's going to have to be a lot more facilities that are capable of launching. You know, is he going to build all of those, you know, Godzilla towers that are going to take and catch these, or, you know, ocean constructs? It's not entirely clear where all of those are going to be. And it seems that there's, in the same way, an argument of the proliferation of airports. We're going to see a similar thing for the proliferation of spaceports. It's already kind of begun. It's got kind of a false start, but I think that, you know, up and coming here, extremely frequent launch is something we have to deal with, because right now we had global launches of, you know, 40, 50 orbital launches in a whole year, and he wants to launch 1,000 of them 3 times a day. That kind of launching we've never seen before. And that there's a logistics question there, which is as of yet to be answered.
Hey, Kevin, thank you for bringing that up after Fitzer left. Otherwise, I know that we would be on the call for another 3 hours.
Yeah.
Could I just chip in, John? Because what Fitzer would say, following on from what Kevin said, is think about the pollution that's going to cause.
That's true.
That's something we're going to have to think about and deal with further down the line, and that's going to keep legal people happy for a very long time to come.
Very long time. Although the carbon emission is, even if you got to that ridiculous launch regime, you would be less than 0.1% of what the aviation sector is doing today. So
Indeed,
like,
Kevin. Yeah.
The carbon dioxide, black carbon, less clear.
Yeah, and also it's where you actually put this material, which is very high in the atmosphere, and nobody knows the effects of that yet.
Yeah, and that's the study of ISAC, of looking into the effects, which I'm also part of ISAC. But the line is that we don't know the effects of that pollution, of what it is to put it up in the stratosphere, and what the effects of black carbon are on absorbing and reflecting in the upper atmosphere. And it's uncharted territory in terms of what it will do. So I again say, the only time we've seen launches anywhere close to that would be V2 launches in World War II against the UK. It's the only time it's come anywhere close. And those were little tiny baby rockets compared to what we're launching now. So we have to figure that out. If we're gonna, expand to a multi-trillion-dollar space economy, the first bottleneck, and arguably the most important, is getting out of the gravity well. And how we do that is a big question.
Wow. In a week and a half or so, I'm going to be out in LA speaking at the Space Tourism Conference, and you've given me well, you've just filled my head full of stuff, Kevin, to talk about. So I have to talk to you too, Nate. All right, guys, we got anything else that we have that y'all want to discuss? All right, like I said, we do this once a month. We try to do it on the third Tuesday, same time. Next month, we're planning on talking about supply chain issues. I'd really like to hear back from y'all on additional topics that you would like to hear or you'd be willing to lead. And for every one of these, I want to drill down because we've just brushed the surface. And I can't tell you how much I appreciate your time and participation. The shameless plug, we are a nonprofit. We need your support to operate. So please help us share the message, membership and sponsorship. Thank you. And thank you, Kevin. Thank you, Nathan. I'm sorry that Eduardo didn't make it. We'll drag him in next time.
Next time, him and Charles, they both didn't make it.
Well, I know.
They were here in spirit.
Yeah, they're here in spirit. I don't know if I could have stood anymore. I mean, it's drinking out of a fire hydrant. But anyway, guys, thank you for your time. I posted in the chat box basically the minutes from the meeting. Kevin, I posted your report, Nathan, your report. And if I find anything else that's spot on relevant, then I'll send it out as well. If you need me, jmw@stellarmodal.org, or give me a call. Phone number's on there. I look forward to talking to you in May when you're in the United States. And guys, thank you so much. This has been outstanding, and I appreciate your time and participation.
And I'll email you the slide deck so you can put that up. That has links in there.
Okay,
But
can I share them?
Ours are nice and easy. Yeah, you can share it. It's
Okay.
Ours is nice and easy. It's just lightbridge.space, and
Yeah.
you can find our work there.
And you've got a lot of great reports there. I've read through them, a lot of great reports. All right. Thank you all so much. With this, we're going to sign off, and we'll talk to you all soon. Thank you.
All right. Bye, everybody.
Yes.